Hey, I'm Robert Brownlee,
Uh, hey, I'm Breck Owens.
I'm Koby Townsend.
and we are analyzing Chipotle.
So the agenda for this presentation, first we're going to do a brief company overview. Then we're going to do a problem identification of what Chipotle was going through in this analysis. We'll run a strategic analysis on it. We'll look at the financial analysis through the balance sheets and income statements. We'll look at some of the alternatives that people have for Chipotle, and then we're going to recommend some implementations to solve their issue and conclusion, and then we'll have questions at the end.
All right, thank you, Breck. Chipotle was created by Steve Ells in 1993. It was based out of Denver, Colorado. By 1998, the company had grew to 16 restaurants and was noticed by some pretty big investors. So McDonald's was a major investor. They injected $360 million of capital into the company. And by 2005, there were over 500 units of Chipotle. This spurred on to be for Chipotle to go public. So they did their IPO in 2006. And once they did go public, McDonald's sold their $360 million holding for a value of $1.5 billion. So Chipotle is part of the fast casual sector of the restaurant industry. That sector does have the smallest share of the restaurant industry. They have smaller buildings to reduce their cost and to also reduce their environmental footprint because of their higher product cost and their sustainable sourcing. They do tend to have a limited menu, and they also use a assembly line style of serving to increase efficiency amongst employees. Chipotle prides itself on food with integrity. They provide clean, sustainable products to their customers. Since their products are sustainably sourced, they do try to work with local individuals and create a supply chain of local producers that stick their sustainability mission.
So the problem that Chipotle is facing is they are threatened by rising food cost, specifically organic and local products. As prices go up to produce these products, obviously the price to sell these to Chipotle goes up. As Koby mentioned, they do food with integrity, and it's something that they are very proud of. So it's something they wanted to keep in their business model. Another major threat is other quick service restaurants. One specifically is Taco Bell. They opened franchises called Katina Bells, which is targeted more as a higher end Mexican restaurant directly to compete with Chipotle. And there were some studies done that actually showed that people eating at Chipotle did, in fact, have positive feedback for the Cantina Bells. Another problem is what's called the Einhorn effect. And this was actually a speech given in 2012 to a group of shareholders. And it was actually specifically talking about Taco Bell and how much positive feedback Cantina Bell was getting. And within 24 hours of that speech being given, Chipotle actually lost 9% of stock. And this is just one example of how the market can heavily affect Chipotle very quickly.
All right. Thanks, Breck. The general environment analysis is used to determine an entity's strengths and weaknesses. Um, in this analysis, Chipotle would be looking to turn any strengths it can into profits and turn any weaknesses it finds into strengths. There are six factors in this analysis that Chipotle needs to consider. Those include demographics, social culture, global, economic, political, and technological. For purposes of this presentation, though, I will be going over two of them that I think are most important. First one is social culture. Um, and the social culture factors include things such as tradition, um, cultural norms, population growth, and any kind of change in eating habits. A few years ago, the change in eating habits kind of worked in Chipotle's favorite. However, now, ever since COVID and increase in costs, um, people are gearing towards more eating at home than going out to eat. So it's affecting not only Chipotle, but every restaurant in its industry. And with that being said, Chipotle would need to look at that particular part of it and ask, how can we bring these customers back to eat at our restaurant? Um, the next factor that consider important is political. And I say this because Chipotle operates now in different countries of the world. So, in other words, Chipotle would need to consider the laws and business regulations of that particular country, as well as taxation, accounting regulations, things like that. Now, if we can go ahead and click to Porter's Five Forces. Here, this technique is used to determine the forces that affect Chipotle's competitiveness within the industry. Um, and I found that a lot of these five forces are going to be the same, not just for Chipotle, but for every restaurant in the industry. The first one is industry competitors. Now, I rated this very high because there's not just Chipotle, there's also McDonald's, Taco Bell, Burger King, Subway, Chick-fil-A. You have your mom and pop food shops. You have sit down restaurants. So Chipotle needs to consider what can they do to keep customers coming back in the midst of all this competition. Um, the next one is the power of buyers, and I rated this high because buyers in this industry have lots of options to choose from, not just burritos or quesadillas, but they have subs and every um, cuisine you can think of, just about. Um, and buyers are always looking for restaurants that meet their needs. So Chipotle needs to consider that. The next one is power of suppliers, and I rated this moderate. Chipotle and every single restaurant in the restaurant industry has a reputation to protect. Um, thus, everyone has to choose wisely in which supplier they want to use, because anything negatively that can affect, or anything that negative happens with that supplier can ultimately affect Chipotle as well. Um, and then also the suppliers, they like to compete with each other to sort of get the big restaurants. Um, the next one I'm going to talk about is the threat of substitutes. Um, and I rate this as extremely high because there's always the threat of a substitute. Um, and substitutes also try to compete using their brand image and marketing power. Um, the next one that I am going to talk about is the threat of new entrants, and I've rated this as moderate. Um, in terms of Chipotle, in any restaurant, the cost to establish a new restaurant in the industry is not very high. Some start out as food trucks, and they work their way up the ladder. It's also not difficult. There are a few barriers to entry in this industry. And the next topic that I will discuss is the VRIO analysis. Um, this analysis is kind of a broad analysis that presents Chipotle an opportunity to acquire a competitive advantage over others in the industry. As you can see, the resources or competencies in this analysis, a lot of these are either temporary competitive advantages, meaning um, they're not going to stay a competitive advantage long. So the question is, how can I take that and turn it into a sustainable competitive advantage? There's also a couple of sustainable competitive advantages. Please note that in this analysis that I did, One unused competitive advantage that Chipotle should consider is the supply chain flexibility. Um, that's all I got.
Thank you, Robert. All right, so moving into the financial analysis, you can see here, this is the income statement for Chipotle for 2009, 2010, and 2011. The cost of goods sold, this includes things such as food and beverage packaging, labor, occupancy, and other operating costs such as marketing, credit cards, things of that nature. When you go down to operating expenses, that's just your typical general and administrative fees, more on your salary side. And then sales here at the very top is the overall revenue. And you can see that the net income has steadily increased from 2009 to 10 to 2011, starting at 126, 845, going up to 214, 945. And these numbers are in thousands. For the balance sheet, this data is only for 2010 and 2011. The total current assets, as you can see here, that encompasses things as cash equivalents, the accounts receivable, inventory on hand, the deferred tax assets, prepaid expenses, income tax receivable. You can see there is 0 for 2011. So that's what gives you your total current assets. And then you have things such as property, plant, and equipment, long-term investments, other assets, some minor investments in goodwill, which equals your total long-term assets. And as you can see, these are also steadily increasing from 2010 to 2011. On the other side of the balance sheet, you're going to have your liabilities, your current liabilities at the top, accounts payable, payroll and benefits, current portion of deemed landlord financing, things of that nature. After that, you'll have your total long-term liabilities, which is deferred rent, financing, tax liability, which you can see add up. And as time goes on, as your assets go up, the liabilities are also going up. But with that, the shareholders' equity is also going up. Slide 10 is where we calculated some of the financial ratios, again, from the data for 2009, 2010, and 2011 on Chipotle. And this was compared to the industry, the restaurant industry, with the most relevant data that we could find in 2022. For your liquidity ratios, and these are how capable a company is of paying off debt, Chipotle is very high in this regard compared to the industry. You can see 3.3, 3.24 versus 0.93, 0.6. The reason for this is due to their business model of owning their own buildings. They don't finance a lot of them, and they don't franchise. So that is why they are very liquid. For the profitability ratios, you can see in red, they're below industry standards in this regard, both in the gross profit margin, operating profit margin, and the net profit margin. The reason being is because of the cost of goods sold increasing, as we talked about earlier. And with that, Chipotle decided that they wanted to stick to their business model of food with integrity, while also maintaining the same price point that they've always been at. And that's why their profit margins are reducing and kind of staying reduced compared to industry. After that, we calculate the leverage ratios, which these are how much capital comes in the form of debt. And it allows lenders to assess the ability for a company to meet the financial obligations. As you can see here, Chipotle, again, is higher than industry standards, 0.72 versus 0.23. Your debt ratio, you actually want to be lower, and they are well below industry standard at 26 and 27% versus 122%. And again, this is due to their business model of owning their companies, or owning their own buildings, not franchising, and just having more cash on hand. Something I would like to note is the NM in the industry standards, which is considered not meaningful. And I'll discuss that a little bit further on the next slide. So here we ran a DuPont analysis, which is broken into basically 3 sections: the operating efficiency, asset efficiency, and financial leverage. And then you can use these to calculate their return on equity. And as you can see at the bottom of the DuPont formula, the 0.19 and 0.23 is higher than the negative 0.8 at the industry standard. But I would like to note that in the restaurant industry, this is usually considered not meaningful due to the fact that in the restaurant business, it's influenced highly by replacing equity with debt, and company management can incur debt or use proceeds to buy back shares, things of that nature, to make this ratio look better or worse depending on what they're trying to do. So for that reason, it's usually disregarded when evaluating businesses in the restaurant industry. So in conclusion, for the financial analysis, Chipotle is less profitable than other companies. This is mainly related to the cost of goods sold, and they maintained their normal selling prices instead of rising prices with their cost. However, they do have more cash and purchasing power than most other countries. They have very little debt in comparison to the other competitors. And their business model of not franchising and owning all of its businesses give them the better liquidity and leverage ratios, which makes them more likely to get a loan if needed.
Thank you, Breck. So for alternatives, we have a few. The first one would be different food options. So in the restaurant industry, it's very common for people to eat different options and to do what they want, pick what they want for that day. So that's always a challenge for Chipotle and then for its customers. Also cook at home, like Robert said, with the rising cost of groceries or with eating out and everything else. People may tend to eat at home more than eating out, or they'll limit it to so many days a month. Also, an alternative, because Chipotle is very big on their food integrity mission. They try to do sustainable products, and they're also trying to reduce their carbon footprint at the same time. But Chipotle does not grow their own products, so we don't believe that their carbon footprint is directly tied to their sustainable products. However, there could be 2 different alternatives. So, unlike McDonald's or Starbucks or Taco Bell, Chipotle is providing a sustainable organic product to their customers that comes from producers, which takes longer. These animals are not pumped with GMOs, with corn. They're grew at a slower rate, so their sustainable products cause them to have some lower profits because of increased cost. Also, an alternative for their carbon footprint, they do in their buildings. They're one of their industry leader in solar panels and reducing their energy output, smaller buildings, increase efficiency. Once again, alternative like any other big restaurants such as McDonald's, they're putting profits over environmental consciousness. So this is also a burden on profits. So for recommendations and implementation, the first recommendation in the short term would be an increase in marketing to attract new customers and prompt existing customers to return. Marketing and social media have become so big in the last decade, especially since COVID and beyond, that it can be increased. One particular target could be through certain apps, phone apps, such as Pandora, Snapchat, for the younger generation. As you're riding down the road, you're listening to music, you might get within a certain distance of a Chipotle at a certain time in the day, and that ad may come on and spur you to go eat at Chipotle. And so increase in marketing budget could really affect profits and drive stock prices as well for investors. For the midterm goals, an increase in prices, they'll need to increase their prices on on a reasonable level as organic products become more expensive. Once again, a slower growing product is a lot more, if you got to put more input costs into them, it takes longer for them to come to market, to be ready to produce, and to be given to customers. So they'll need to monitor their operating costs and adjust accordingly to customers, but do so in a way that doesn't send a shock and reduce people coming in and ordering. For the long term, as Breck said, they do not franchise it. They not franchise. They only own businesses, and so allowing that franchise and allowing people to purchase shares and then operate themselves under their name would increase profits, increase footprint, just as McDonald's does, Starbucks, Taco Bell, all of them as well. Also, because Chipotle provides such a sustainable product and the good quality, they might look into full service branch, a sit down restaurant. Because if you're on the run, you run in, you get Chipotle, you leave, or you're on your lunch break, you're on the phone, you're talking, you're not too much paying attention to the quality of the product. You're more so just eating and going on about your day. Where if you sat down and could get a real feel and taste for what the product's worth, what it means to you, what the value is, you might see a very big increase in profits there, just as other sit down restaurants who are heavy on sustainable products and environmental friendly. So in conclusion, Chipotle has taken a proactive approach to sustainability through their products, through their environmental footprint. They're one of the industry leaders in this, and they were one of the first. Also, because of their increased international footprint, that does mean that in their general environment, such as political, they do have to abide by that nation's laws and regulations, as well as play to the political bodies that are there. As new parties come and go, new laws come and go, and they're changed to meet certain standards as well. Profitability ratios were well below industry standards in 2010 and 2011, as we said, because of the organic products and the cost of those to provide a high quality product instead of a mass produced or frozen product. This will come with increased cost. Chipotle may charge a little more and may deter some, but it won't deter all. And then lastly, recommendations for the versus current market share. Currently, as of 2022, Chipotle is third in the industry. They have a little over 9% of the market. They are behind McDonald's, who is first, and Starbucks, who is second. And they do currently have over 3,100 locations worldwide.
Thank you, Koby. And after that, we'll leave it open to questions. Please feel free to contact any of us if you have any questions on the topic or further analysis. And then we'd just like to show our references for this analysis. Thank you.
Thank you.
Thank you.